Let's discuss why car manufacturers are still suffering in 2023, despite reduced production costs, and how it might affect you. Since people were not able to spend their money on vacations, entertainment, or any other activity during the lockdowns, they began purchasing new vehicles. Before COVID arrived, 17 million vehicles had been sold in the year 2019. According to JP Morgan's predictions, even after accounting for the 14 to 14.5 million U.S. light vehicle sales in 2023, this figure falls short of the pre-pandemic benchmark. Intense labor shortages and supply chain issues still remain a big challenge. As if that weren't enough to cause problems for automakers, the war between Russia and Ukraine resulted in additional trouble in industries like metals, chemicals, and of course, energy. On average, individuals were interested in spending $49,075 on a new car in December. However, not everyone can afford an expensive vehicle. When new car prices appear to be too high, consumers start looking at used car choices. What's making the idea of car ownership a nightmare for a lot of people these days are gas prices out of control and much higher monthly payments for the same cars due to skyrocketing interest rates. Not only that, but we also observed a 4.2% increase in car prices year over year back in January 2023. Given how many nightmares 2022 has brought us, inflation is still a huge problem and is likely to remain that way for an indefinite period of time. Even though JP Morgan's Weighted Commodity Index study gave us reason to believe that the cost of producing a car would fall by 24% this year compared to 2022, we still have the non-commodity aspect to contend with. So even though manufacturers are currently enjoying their primary commodities, such as synthetic rubber, stainless steel, and cold-rolled steel at a lower price rate, other aspects such as labor and energy are still a consideration that affects their profit margins. SUVs, which once dominated the market, experienced the biggest annual price drop of 16.6%, while luxury vehicles experienced a 15.2% decline. According to JP Morgan, new car prices will fall roughly by 2 to 5%, and used car prices will drop by approximately 10% in 2023, which could be devastating to direct customers. According to car gurus, the current average listing price of used cars is $28,537. Seems like consumers are still spending significantly more than they did before COVID-19, and we have a long way to go down. Before this, the average listing price was only $21,300. During the free money era with stimmy checks and zero interest rates, dealers have been selling used cars above their MSRP rates due to their clients' desperation to obtain the vehicle. People were competing against each other for the finite number of autos, making prices skyrocket artificially high. There was a massive spike in demand for used cars, creating a bubble. The auto industry is cyclical by nature and seems to be going into the down cycle with the fears of a prolonged recession. Because most car purchases are made with credit, the situation for borrowers seems to be getting worse month by month as the Fed hikes. People's buying power is suddenly not there anymore with much higher interest rates. JP Morgan reports that average rates for new vehicle loans increased up to 6.79% in January. This inevitably crushes demand as fewer people can afford higher monthly payments. The chief economist at Cox Automotive, Jonathan Smoke, has been heard commenting, "For more than 6 months now, we've been dealing with the abnormal situation that good news, like a strong employment report, is bad news for the vehicle market, as it means the Fed will push rates even higher." The average monthly payment year over year for a used car in America has climbed by 11.2%, 13.3% increase for new cars, and 12.1% for leased cars. Even if we look at the statistics for used cars, which have the lowest average monthly payments, they still amount to $525. Ryan Brinkman, lead automotive equity research analyst at JP Morgan, commented, 80% of Americans who finance or lease their vehicle may not experience any relief, given that a 100 BP rise in interest rates translates into an approximately $20 increase in monthly cost. It may not appear to be much at first sight, but when the 72-month loan period adds up, the amount that has to be paid by borrowers is significantly higher than they anticipated. They are shelling out a lot more money than their car is worth. With the price of used cars decreasing by almost 1.42% month over month on a wholesale level, the market is about to see the worst phase. Let's now discuss the effects that this crash may have. Due to the significant ADESA acquisition that Carvana made in 2022 and its high debt load, which caused higher expenses, the company is on the verge of going out of business. Although it is not currently using the same phrase, it does sound worrying given that it has just $434 million in cash on hand and huge loans hanging over its shoulder. In the same vein, keep in mind that when Lehman Brothers filed for bankruptcy, it put a lot of businesses, including the Royal Bank of Scotland, in danger of collapsing. Similarly, this Carvana crash may have a significant effect on the auto industry. U.S. News & World Report, however, has been heard stating that May will be the ideal month for you to grab those sparkling steering wheels if you have an urgent requirement. Since the flashy new car models are beginning to arrive at the stores, dealers will make every effort to sell the previous year's vehicles at significant discounts. As per Tyson Jominy from J.D. Power, the inventory is soon going to be increased, which would bring the pricing to a lower point. Even though some businesses, like CarMax, had the worst third quarter results in December 2022, we must keep our fingers crossed for the future. The shareholders of this industry's companies are already suffering as many of these stocks plunged big time last year. The Manheim Used Vehicle Value Index indicates that car prices are going to be down 4.3% year over year in the upcoming December. The finance manager at Stephanie Morris Neeson, Warren Gutierrez, recently commented, "Whenever you shut things down, whether it be our economy or economies overseas, where we'd get a lot of these parts, it just creates a ripple effect of chaos." Those who purchased vehicles in recent years are now experiencing a worse situation because they aren't likely to be able to sell them at an appropriate price, taking into account that they spent more than average for their car. Even the lead automotive equity research analyst at J.P. Morgan, Ryan Brinkman, has been heard quoting, "The road to recovery may be less rapid and less linear than earlier thought."